Okay, now let's take a look at performance evaluation. Okay, so performance evaluation is a very important part of accountancy. Why? Because you see, the accountancy, what is behind accountancy is the basic concept that you get what you pay for, right? You are able to exchange benefit based on the cost that you provided, right? So you are exchanging, you're sacrificing resource for something of equal or greater value, right? So how do you know that you get something of a greater value? And when you invest into your company, you said, let's do an R&D, okay, let's start a new factory, and let's get a new division setting up, right? How do you know that you get what you paid for of equal or greater value? And so that's when performance evaluation come into play. It's not just about evaluating some individual's performance, like in what they do in HR department. Okay, a lot of times, sometimes you evaluate a department's performance, you evaluate a particular marketing campaign's performance. Okay, you evaluate a sales campaign or advertising campaign or a sales promotion, right? You evaluate those performances to make sure that you are getting what you pay for. So when it comes to performance evaluation, the first thing we take a look at is something we call accounting income. Okay. So what is accounting income then? Accounting income is the profitability that has been compiled using accrual basis of accounting with adjustment made to reflect the change in net asset during a period of time. That's what accounting income actually means, right? It's a mouthful, right? But if you really think about it, see, let's say last week I bought a computer, $3,000. Wow. And then, I can use this computer to make new slides, make better teaching material that will sustain me for the next 5 years of my teaching career, right? So when it comes about spending that $3,000, I'm supposed to spread that $3,000 over the course of perhaps 5 years, right? It's not just $3,000 out, right? So same thing when I get some benefit, somebody paid me to have some private tutoring, right? Okay, so paid me for a 3 months worth of course, paid me $1,000, $2,000, whatever, right? So that income does not necessarily mean I got the income last week. That income is supposed to be spread out into a month because I have to actually deliver the course in order to recognize that revenue, right? So accounting income is exactly that. Right? We have to use accrual basis accounting rule with adjustments made. Right? Certain adjustments need to be made, like for example, how do I spread out the MOH, right? Either it's manufacturing overhead or management overhead. That's sometimes confusing. MOH means two things, right? To reflect the real change in my net asset during a given period of time. Okay, so some may ask, then what's the difference between real income versus accounting income? Then what's the difference? Let's think about it. What's the difference? It's actually a trick question. Real income, the concept doesn't exist. It does not exist. Right? In any business sense, in accounting sense, it doesn't exist. Right? The income is always considered in the certain logic to reflect that, okay, so realistically, how much resource that I put out, right? Logically speaking, the resource is expensed this way, and how much benefit that I get over a period of time, right? So I can understand how much that I made, okay? And also cash flow itself, like we discussed earlier, I spent $3,000 and but I get $2,000 as a payment to my service. Cash flow cannot be used to reflect income. That's a very, very misleading figure. And this is usually one of the mistakes a novice business people make. They treat cash flow as income. No, that's not. Okay, so when we look at accounting income, the terms that we use for accounting income, there are a slew of them. Revenue can be considered an accounting income once it's recognized, right? Okay, like earlier we said, if you provide a service that is scheduled for 30 days, right? Okay, are you able to recognize the revenue right away? Like for example, if you are a cell phone carrier, right, and you go on a prepaid scheme to charge your customer, right, are you able to recognize the value, the revenue, when the monthly fee is paid to you? You cannot, because you haven't delivered the service in the full 30 days term, right? So if the customer were to cancel their service anywhere within that 30 days, depending on how the contract is written, they may deserve a certain portion back, right? So from the accounting sense, can you recognize that revenue, right? When you get that $100 or when you get that monthly fee, that's a different story. We can also use profit. Okay, so we already know that revenue minus cost of goods sold is the gross profit. We can sometimes call the gross margin. How about net profit? Okay, net profit is a weird term. And in real accounting, we rarely use this term, net profit. It's a very confusing term. What do you mean, net profit? Okay. So put a cross to it. We don't use this. It's amateurish. Okay, we use terms like operating income. So what's the difference between gross margin and operating income? Okay, minus period expense. After all the period expense are paid for, right, then you get your operating income. Okay, and sometimes operating income can be called as earning before interest and tax. Right, you haven't paid those things yet. Okay, that's operating income. Right, so sometimes we can call it after tax income. Yeah, but after tax income is also a layman's term. For a real accounting term, we call it net income. Okay, so these are all what we call accounting income. So when we compare performance, let's say this Monarch Enterprise performance, right? If we want to compare accounting income, there are several options for we to go. We can compare their sales revenue over here. We can compare their gross margin over here. We can compare their operating income here. And then we can perhaps compare their after-tax income. So you see, all these numbers, they differ a little bit, right? They differ because they have different meaning. Right? So we know, you see, the gross margin, the difference between gross margin and the operating income is the periodic expense. Marketing, HR, right, utility, all that, the things that you have to expense in the period, right? So if a department use a lot of period expenses, does a lot of marketing, right, or hire a lot of people, then they will have a very heavy period expense, and their net income or their operating income may not look as good, right? So you see, whenever we use accounting income as a measure for performance, the pro is that it's easy to understand and compare, right? It's very easy to see, okay, you make more money, you make less money, okay? And it's the results of accounting income is usually reflect the decision and cost, right? So we can see the numbers, they are summarized in a very easy to read way. But the con is that, how about the size of the division? We don't know. We only see the result of the number. We don't know. We don't know whether the responsibility of the division are the same, right? After last week, we learned about responsibility accounting. We understand that some divisions may not be responsible for making profit at all, right? Some divisions are just there to make certain things, to do R&D, right? We cannot use accounting income to evaluate them. All right, maybe problem with the geographical location, they're in different places, right? Okay, you can't compare a New York division department store, right, into another department store in Tulsa. Right? You can't do that. Right? They sell different things, and department store in New York may sell a lot of masks, right? And department store in somewhere Midwest, right? Did you guys see the news that it's a really disgusting the Arizona City Councilman? He come out and talk about wear a mask, and his whole thing is like, oh, I wear mask, I can't breathe. He's using the George Floyd, I can't breathe, and saying that, oh, I wear mask, I can't breathe. It's disgusting. It's like, okay, then don't buy them, don't wear. Breathe as much as you want, right? So geographical location may affect companies' sales performance. Okay, so we cannot use this division income or accounting income to determine if managers have made good decisions. We don't know because we only see the number as the result. We don't know whether it's better than before, worse than before, right? Or they have made the right decision in terms of certain things they do, right? We don't know that. Okay, we may produce misleading performance benchmark because of this. So that's the problem with the divisional income, or use accounting income for base of comparison. So what that means to us is just income doesn't tell the whole story, right? It doesn't tell us how well do you run your department. It doesn't tell us the how good you did compared to before, or compared to a comparable division, comparable size. It does not always give us an apple to apple comparison, right? So if we were to look at how do we accomplish performance measurement, let's look back the basic rules. So we can analyze by financial statement, and how this that can be done is, first we call it horizontal analysis. Okay, so what a horizontal analysis is, we can do that in across different period, right? We analyze this department to a different performance in a different period. We can use it to across different divisions, and we can use vertical analysis to see report each amount under financial statement as a percentage of something else, or compare the performance on the vertical value chain function. So what that means is this is actually quite simple. A lot of students have the problem understanding the term horizontal analysis and vertical analysis. It's really as easy as looking at a financial statement. So if you have a financial statement, there are terms over here, and numbers, 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 numbers. So this is 2018 performance, and over here is 2019 performance. Some other numbers here, some other numbers here. So if we're looking at what is horizontal analysis, this, you compare things horizontally. That's what it means, horizontal analysis. And vertical analysis is that you compare things vertically. Oh, this revenue is, okay, and compare this to, let's say, net income line or operating income line, then we can find the gross margin over this. It's called the gross margin percentage, gross margin ratio. So when we do things vertically, right, we call it vertical analysis. So it's just actually as easy as that. Horizontal comparison and vertical comparison. So we know it's just not just numbers. The secret is that sometimes you can use ratios, right? Or difference in difference analysis to compare different divisions, division A, division B, or division A's 2018, 2019, things like that. Right? So we can select proper time horizon to do that. We can select comparable subjects, comparable responsibility. Okay, we can select relevant information, like for example, historical cost, replacement cost, book value, opportunity cost, cost of idle capacity, okay, or select the relevant range of the fixed cost to be in this vertical or a horizontal analysis rule. So what that actually means is that you can make more numbers out of this financial statement. Just the dumb accounting income is not enough, right? You can find out the accounting income's ratio to the debt, right? Accounting income's ratio to the investment shareholders' equity, right? There are many ways to do that, to tell more information, right? Okay. So performance measure can be done in different levels. On the industry level, compare against the industry benchmark. Can be done on the market level, compare against your competitors, like Apple. Probably want to compare their iPhone performance to the Samsung, right? And on the firm level, right, you can do what we just call the horizontal or vertical analysis within your company on the firm level. Or on the board level, you can compare against board specified strategy or objective, right? For example, you may set up things like this. Okay, this is a board objective. Like last time we talked about the budget the board set with regards to the production objective or the sales objective, and compared to what is happening actually, right? Actual performance and the board objective, right? Or we can compare to the senior management level to benchmark the ROI growth, cost of the leadership strategies, different type of strategy. Compare, let's say we don't have actual, we have, this is board objective, this is management strategy, strategy A, strategy B, right? To see different strategy will perhaps yield a better result, right? Or on the line management level, and this is usually done through variance analysis, which we will cover next week. We can compare the input cost, okay, the ABM, the MBO costs, and the HR incentive compensation or internal control on the staff level, right? So the most used number when it comes to compare the performance evaluation is something we call the return on investment. Okay, so the return on investment is an accounting measure of income divided by an accounting measure of investment. And usually this is what we call the total asset. So what that means over here graphically. Okay, so this is the thing that you invest. Let's say you invest a company, make what I want to make. What is hot here right now? Yeah, let's make some kind of juice called I am peach mint drink. So you have a factory making this impeachment drink. Yes, that nice name, eh? Okay, so you make this drink. So you put money to buy the factory, to buy equipment, to buy raw material, right? You put all sort of money in there. And not only money, you also invest in your own labor, right? Your heart and sweat, and then you put some advertisement. And in the end, you make money. Okay. So how do we make sure this investment is worth what I put into? Okay, so that's what we are looking at, return on investment. So the first thing is we're trying to see is the accounting measure of income over the investment. That will give us the ratio number. Right? So sort of look like this. ROI equals to accounting income over investment. So this investment, okay, number is an accounting number that you can decide. Usually is total asset right? But total asset sometimes does not really reflect the entire investment, does it? Because you see, here you put in labor, you put advertisement, these are what we call the period cost. It's gone. Your book, the balance sheet, does not record this, right? So if you're putting a lot of money into advertisement, right, and those are period expenses, it does not reflect in the total asset, okay? It may not give you a good number of this ROI because your denominator is wrong, right? You did not try to include this period cost as part of your investment, okay? So this income number on top, they also have a problem. What is this income? It's an accounting income, so you can choose, remember, different terms for this accounting income. You can use profit, revenue, gross margin, you can use operating income, you can use EBIT, you can use net income. So which one are you going to choose? Right? So that's the ROI. So a lot of times that the student always ask, Professor, I saw this ROI formula over here. It says this, net income over net asset. And then somebody says, no, Professor, I saw another one. It's gross profit over something else. Okay? Because there's no set formula on ROI. It's just a accounting income over investment. And it is up to you, the accountant, to decide what is the definition of accounting income and what's the definition of this investment. You have to make that recommendation clear, right, to your users. I'm using this. Why? Because I want to capture the entire investment, including period expense. Right? You may want to do that. So, in addition, the ROI may be broken into two components as follows. Okay. So we over here is income over investment is income over revenue times the revenue over investment. What that means is over here. Let me write it here, down here. Okay. So income over investment equals to income over revenue times revenue over investment. Right? Did you see how interesting this formula is? If you just cross this out, revenue, right? You get the same thing, income over investment. But this is actually two components over here, because you will see over here, income over revenue, this is your return on sales. Okay, and then revenue over investment, this is your investment turnover. Okay, so what does that mean, turnover? So you can, it's like if you put $100 in your company, right? You get $500 revenue. That means you turned over your $100 5 times, right? So that's what I mean, investment turnover. So a lot of times there are some businesses have really, really good investment turnover, like drugs, right? Yeah, you buy something, find some guys, yeah, here I buy a kilo, right, of this, and I can turn over on the market for how much money. Yeah, but the risk of those businesses are so great, right? Right. So that's what we are looking at, ROI. So I don't want to hear from my students that say, oh, which ROI formula should I use? Because you are the one supposed to determine. You are the accountant. You are the one supposed to define the right ROI to choose in the right situation. Right? This is not the question supposed to be asked. Right? So some student may ask, hey, Professor, what if I use this ROI, and then they come up with a different answer? What will happen? Usually that's the time you can challenge, you can say, the Professor, I use a different ROI formula because I think this ROI calculation will capture more information. And that's usually a good sign. And that's why management accounting is so hard down the road, because it requires you to make management decisions, right? To tell the managers why you're using different formula, why you're using certain formula, why you're calculating things certain ways, right? Okay. If you just use the dumb accounting income with no considerations into the horizontal analysis or vertical analysis, then your analysis will not be good, will not be of good quality. Right? Or if you use return on investment and you do not consider what different accounting income or different investment measure to capture investment, right? Then, yeah, it may not be very good. So ROI, the most popular approach is to blend all major ingredients of probability, revenue, cost, and investment into a single number and compare to other ROI both inside and outside the firm. Okay, and ROI can also called, this is the same thing, accounting rate of return, ARR. So whenever you see ARR, right, or AARR, accrual accounting rate of the return, it's exactly the same as ROI. Right? Because that's the reason why it's called accounting rate of return is because we are using accounting numbers. Okay? To get that. And now you understand what does accounting number mean. Right? Accounting number means that we are capturing this number, okay, after the accrual basis of accounting is considered and the adjustments, right, are made. Okay? So that's why it's called accounting the rate of return. Right, so over here, they blend all major ingredients of probability. Some company do is that they do some kind of formula, right, to show, okay, what's revenue mean, what's cost mean, what's investment mean, and then blend this thing together into a formula like this, right, and to determine those numbers. Okay. So same thing that I emphasize over and over. ROI is a general ratio who does not specify a strict definition on return or on the investment. It's not strict. It's just accounting rate, a ratio of a return. Okay. The return can be any accounting number, and the investment can also be changed. Right? Sometimes the investment are changed to shareholders' equity. Okay, sometimes the investment change to this, right? Because why? Because if I have a company that say a company's asset is 500, I have a liability of 200 plus 300 shareholder equity, right? If I want the number reflect on how much the shareholder equity has contributed to income, right? How important is the income per share, they called it earning per share, right? I can use the shareholder equity to get approximation of this earning per share type of number because I can find the number of shares in this shareholder equity, right? To see that what is either earning per share or earning or ROI based on shareholder equity, right? So of course you can also use ratio to this ROI on liability. Right? Go. So just a quick quiz here. Use your the group chat to type it in if you want. Right. So one of the common question we get asked a lot from students is, why, if I borrow money, why is it considered an asset? Right. So does that mean that I can, if I want to make my company's asset to 1,000, I just borrow more money? Right? Let me see. 700 plus 300. Does that actually mean that? Right? So explain to me why liability is considered part of asset. Think about it. Why is liability part of asset? Kulan said company borrowed money to do something. What else? What else do you guys think? Company borrow money to do something, maybe by producing more product. Right. So the idea of this liability share, the asset equals to liability over shareholder equity. This comes back to the idea of the definition of asset. What is asset? Asset is the resources that you control to generate future income. Right. So the ability to borrow money is an important asset that you have. Right? I have good credit. Right? I can borrow money from this bank, from that bank to make more money. Okay? Therefore, this is considered part of asset. Right? So if you can, let's say, oh, I know how to invest. I know how to make a killing in the real estate market. Right? So yeah, even bank charge me like 10% on interest to borrow money. Guess what? I can make 15%. Right? In the real estate market, I still make 5. So that's what it means, asset. So it's extremely important for the bank to see what is your ability to make debt turn into money. So they will look at ROI in terms of your net income over liability to see how well, right? You can use your debt to generate money. For every dollar you borrow, you can make certain amount of money, right? So that's what this type of accounting rate of return mean, right? So this is sort of the things that the type of how do you call that? The type of earlier we said that the prep class is supposed to cover, right? To really ask accounting student to understand this simple formula here, right? Even though it looks easy, but a lot of the accounting concept actually come directly from this formula. We talk about 2 things already, right? So we talk about insolvency, bankruptcy. How does it relate to this asset equals to liability plus shareholder equity? Now we all even talk about this, what is meaning of asset from this perspective, right? Okay. All right. Okay. So this is important to compare 2 ROI ratios, and that the definition of return and investment are constant. Why? Because sometimes you see the ROI comparison, like income over investment, and versus another income over investment, right? The problem if the investment definition are different, right? You get different comparison results. Same thing, how do you define income? So sometimes those like the finance major student, they have a problem to understand this. The finance major student, they take those formula as is because they don't understand accounting, right? So they take ROI. Okay, we got ROI here, we got ROI there, but they never venture to thinking about whether the ROI are using the same way, right? Same formula, right? Or same accrual, right? To method to come up that income number. You see that? Even for the same company, if you choose a different accrual method, right, you may come up a different income number. So it's very important. Don't take those ratio as is. You have to look into it. Right? How do you define income? How do you define investment? And there's also a limitation to ROI investment, ROI way to looking at things over here. So you see this organization set a goal of 20% ROI goal, right? And then you have a Western division manager over here is reaching at 22% and Eastern division manager of 24%. So what does that mean here? Let me show you here. See, organization goal is at 20%. And the Western division is currently performing at 22%. And Eastern division is at 24%. Right? So what that means for this company, for Eastern divisions, Eastern division will not take project anything between 20 to 24. Why? Because if Eastern division take project between 20 to 24, that will make Eastern division's performance go down. Right? Even though the corporation just want 20%, they consider 20% safe. Right? The higher return that you're looking for, higher ROI return looking for, is always potentially more risky business. There's no free money. It doesn't grow on the tree. Right? If you are looking for high return investment, it's always risky. Right? Okay. So corporation actually want is safe. Just give me 20. Right? But then the Eastern division is not going to take anything between 20 to 24. And same thing as Western division will not take anything between 20 to 22. That shows us some of the limitation of ROI. Okay, so let's take a break. It's 7 now, and my throat is getting really dry. So let's get a 10-minute break. Let's come back like 7:15-ish, right? And we'll continue on this chapter. Yeah. Yeah, I'm reading that right now. So you can probably shut your computer down now and come back in 15 minutes or so, right? Hello, hello, hello. Hmm. Oh, God damn it.
Oh yeah.
Hey guys, it's Anna.
Give me your drawing, please. No. Okay,
They're
bye.
all wet. I can't give it to you. Puppy, she wants to give me her painting, but it's like wet. I can't give it to you if it's wet. If it's wet, you're gonna
Just blow dry it. It's
not
not wet. You just don't want to give it. I know.
It's wet.
You're just a strange person.
Don't touch it. Don't touch it right now.
No, not today. The one like last week one.
You just catchy
You really want to be artist?
bitch.
Artist want to sell art, but sell this person.
Oh, you just said you want my cherry one. I just
No,
said
the
my
cherry one. Cherry one is wet.
I just said that. What's the cherry one? Yes, you did.
Mhm. All right, let's come back to class. All right, let's come back to class. Okay, so here, in addition to ROI, we can also calculate something we call the residual income. So residual income is a different idea. So residual income, the calculation is income minus a required dollar return on the investment. Okay, so the required rate of return ROR over here, okay, is the company's what we call the weighted average cost of capital, and you don't need to worry about this. This it's out of the scope for this class. So the required rate of return is usually given. Okay, so this is actually the after-tax average cost of all long-term funding, but you don't need to worry too much about it right now. Okay, and later I'm going to show you how it is calculated in the test situation. The reason why the required rate of return is important is usually happen to a particular industry that we see, and from time to time, you guys, let me see. Do you guys like watching movies? How many of you like watching movies? Movies. Yeah. So this is how movie is made, right? So when somebody have an idea, wrote a script. Okay, wrote a script, and this script got bought out by some movie studio, a big movie studio like 21st Century Fox or whatnot. So after the bought studio, somebody think, this script is good. Let's try to attach some director to it. So we'll find somebody, a director, a Quentin Tarantino or something, and then you find some big time star, right? And then you get some other company to invest in this movie script because it takes a lot of money to make a blockbuster movie, right? Sometimes it goes into hundreds of millions of dollars to make one movie. So sometimes what they do is they get investors. And nowadays, what is a good investor for a movie is the Chinese companies, right? Chinese companies are really eager to get into Hollywood, so they will invest anything. You see that Alibaba try to put money in, let's say, the Mission Impossible, the latest one. It has a Chinese money back it, right? And so on the other end, that's their investment. And how do they recoup this? They sell movie tickets, right? They sell it online. They sell DVDs and whatnot. And the part is selling movie ticket is called the box office. Right? So a good indication of a movie flop is that the movie cost $300 million to make, right? And only turned $200 million box office, right? But then the question is, if the movie made $300 million, break even, does it break even? Is that good enough to make a movie breaking even? No, because you see, there's a cost of capital. Idea. You ask people to devote time and effort and money into it. Okay, for the investor, they can put, instead of movie A, they put in movie B. They can perhaps make money, right? So there's an opportunity cost for this investor to consider. All right. So when you're looking at a return on a investment, let's say making a movie, this ROI may not be a good indication, right? We don't want this. We want to see this residual income. Why? Okay, so then you have to see it this way. So this movie made $300 million to make, and perhaps within this 300 million, 100 million is from the studio back itself, and another 100 million is from another investor. Okay, and the studio said, for me to put $100 million in it, in this, I need to make 10%, at least 10%, right? Or otherwise, it doesn't make sense, right? So the studio looking at 10%, right? And then for the investors said, oh, come on, I can put in stock market will give me 10%. No, I can be put in some mutual fund that will give me 10%. If you want to put money in your movie, I want 20%. So the investor is looking at 20%. So that's what we mean, the required rate of return. So for this money, for this much money, $300 million budget to make, and with the consideration of the rate of return, okay, then we have to see this is actually 110 million, and this is actually 120 million, and plus the other 100 million from various sources, from bank or whatnot. So 100 million. So this is actually what we see here, the required rate of return times investment, right? So we are looking at 330 instead of the 300 million budget that we're looking at, right? So if you made the money and then the box office turns out to be 500 million, then the residual income will be 170 million. Ta-da! That's the concept of residual income. It takes into consideration of this required rate of return, ROR. Okay, so this required rate of return can be calculated from many things. Usually, the simple most way is the federal rate, the safest rate, the long-term 20-year bond rate. Okay, there's a safest rate. It's like that means like I just don't do anything in my money. I just buy long-term U.S. bond. I still make money. That's what the base rate has to be, right? Okay, and there are other rates you can go, right? So let's say the investment then itself wants something, right? So that's what we called the required rate of return. And sometimes you have so many sources of rate of return, right? And then that's why there's a calculation called weighted average cost of capital, but you don't need to worry about the calculation of this at all. It's out of scope, but you just need to know something like this is there. And the next one is what we call economic value added, EVA. Okay, this EVA is a type of residual income calculations that recently gained popularity. Okay, it does not use GAAP accrual numbers. It doesn't use it. So EVA is usually the annual after-tax income minus the cost of capital. This over here is the cost of capital. Okay, and the cost of capital calculation is not covered in this course. And sometimes the EVA, the calculation of EVA, there's no standard way of calculating the EVA. So if you see this kind of question, the way of calculating EVA is usually given in the question, right? Oh, this is the way they calculate EVA, so you don't need to memorize how EVA is calculated, right? So the next one is the after this, you don't need to worry about the ROS either. Okay? If you have ROI, the residual income, and EVA, okay, you can put them on a time horizon to compare, okay, and you maybe adapt to evaluate the multiple periods of time, okay, and this will prevent you to cause like a short run increase in some of the measures. You're looking at long-term trend instead and using a consistent number to do that, okay, and okay, so you don't need to worry about this. That's just some other information that from my old slides, you don't need to worry about it. The problem with the performance measurement is that you have to realize that there's more than one way to evaluate performance. The upper number, the denominator can change, the denominator can change. So you really need to build an arsenal of toolkits when you are approached to do this kind of performance measurement in the real industry, right? Earlier we discussed the denominator can be liability, the denominator could be shareholder equity, the denominator can be the number of total shares out there, right? So you have to understand what each type of performance measurement potentially implies, right? Okay, so and ask yourself what's the significance, right, about these type of performance level. And in audit, you always have to ask whether certain measures will make numbers above or beyond the materiality level. If it is above the materiality level, and then that number is important, right? So like this case with Wirecard, and the most likely that the auditors saw that $2.1 billion is above the materiality level, so they make a red flag on that, and that's how we discussed everything. All right, so let's take a look at the problem 13, 46 through 48. Right, let's open it up over here. Clear those, clear canvas. Here's my pen. So same thing, and just open that web page on your end, because we probably can't see it clearly over here. Let's see, mark right here, connect. Okay, let me just find it. Oh, no, it's not 1346, it's 1446. I'm sorry. It's 1446, not 1346. This is the budgeting type of question. Nice. Cursor. 1446. Over here, let's try to read it together. All right. Says here, say Oscar Clemente is the manager of Forbes divisions of Pitt Incorporated. Are you guys able to see the text? Oh, okay, I see some people knock their head. Let me see if I can make it even better than this. Looks not. Yeah, I can't. Sorry about that. Yeah, okay. So, all right, okay, we'll make the text even bigger. It says it's a manufacturer of biotech products, and the Forbes division, which has $4 million in asset, manufactures a special testing device. At the beginning of the current year, Forbes invests $5 million in automated equipment for the test machine assembly. The division is expected income statement at the beginning of the year was as follows. So at the beginning of the year, their sales revenue at 60 million, the operating cost. Okay, so they use this variable income statement, and so here 2 million in variable costs and 7.5 million in fixed costs, and depreciation for the equipment is 1.5 million, depreciation for others is 1.25 million, and division's operating profit is 3.75 million. Okay, and a sales representative from LSI Machine Company approached Oscar in October. LSI has for 6.5 million a new assembly machine that offers significant improvements over the equipment Oscar bought at the beginning of the year. The new equipment would expand division output by 10% while reducing cash fixed cost by 5%. It would be depreciated for the accounting purpose over a 3-year life. Okay, depreciation would be net of the 500,000 salvage value, okay, of the new machine. The new equipment meet Pitt's 20% cost of capital criterion. If Oscar purchased the new machine, it must be installed prior to the end of the year for practical purposes. Though Oscar can ignore depreciation on the new machine because it will not go into operation until the start of the next year. The old machine, which has no salvage value, must be disposed of to make room for the new machine, and Pitt has a performance evaluation and bonus plan based on ROI. The return includes any loss on disposal of equipment. Investment is computed based on the end of year balance of asset, net book value, ignore taxes. Right. So it asks the calculation, what is Forbes division's ROI if Oscar does not acquire the new machine? And B, it asks what's the Forbes division ROI this year if Oscar acquired the new machine. So if Oscar acquires a new machine and it operates according to specifications, what ROI is expected next year? So let's do this. Okay, we are asking for return on investment. Okay, so now what we need to establish, okay, is the accounting income over investment. Okay, so how do we define the investment over here? Okay, so let's take a look at it again. for division which has $4 million in asset. Okay, so that $4 million in asset, it has to be perhaps incorporated. So the way to do it is okay, you set up a different area. Okay, so you find the definition of accounting income, and then the definition of investment. Okay, so over here we see, okay, there's $4 million in asset. Okay, at the beginning of the current year, Ford invests $5 million in total automatic equipment for the test machine assembly, right? And the division's expected income statements over here. It's division operating profit over here. And the sales of the final science machine approach, this we don't need to worry about that. Okay, so over here we already know. Okay, we are looking at the income, the division operating profit at 3.75. Okay. Yes, of course there are others like sales revenue here, right? But it most likely when we talk about income, right, and one of the income line is considered, and it's usually safer to use any one of those income line instead of using a raw revenue. Okay, unless that question has specified that to use revenue number, okay, over investment. Okay. That's usually not the case. Right, so let's keep taking a look. So definition of investment. So we have the beginning of $4 million in asset, right? And plus invest in $5 million in automated equipment, right? And then the depreciation over here is given to us, right? The depreciation of 1.5 and depreciation of 1.25. Okay, it's already depreciated. Okay, so that which give us what number over here? We have 3,750,000, 3.75 million, and over here our base of investment is 4 million plus 5 million. Okay, that's a new asset, right? And then we depreciate it with 1.5 and also 1.25. Okay, so because this is what we call the net asset. Right? And this gives us let me take a look at the number it gave us. 60%. Did you get 60? Did you guys get 60? Yeah. Okay, so item A is 60. Okay, does not acquire the new machine. Okay, so what if Forbes division ROI this year if Oscar acquired the new, this $6.5 million machine? Right, so same thing. Let's make the definition of, let me write it down again. We have accounting income over investment. Okay, and now our accounting income over here, let's write it down. ACCT income is, and then is 3.75 million. Okay. But is this number good enough for the accounting income? No, we need to consider the loss of this old equipment, right? Do you see that? Because the old equipment has to be disposed. Okay. What does it say? What does it say? Okay. The depreciate over 3-year period of time, depreciation will not be net of 5 times salvage value of the new machine. The new machine, if the Oscar purchased a new machine, it must be prior to installed for practical purpose. Okay. Where did this say? I forgot. I have to dispose of the return. Okay. A performance evaluation bonus paid based on ROI. The return include any loss on disposal of old equipment. So investment is computed based on the end of year balance of asset. So when we're talking about this, then we have to consider the loss of disposing the old machine. So the loss cost of disposing the old machine is calculated to the value of 5 million. 5 million and minus the 1.5 depreciation of the old machine. So actually the actual income for this for this situation would be 3.75 minus what? 3.5 million, because we need to consider the disposal of the old machine. Right over here on the investment side, we consider what is in the investment is original 4 million, right? The original 4 million. Okay, and we also we need to consider the added what? The new one, 6.5 million, right? And how about the depreciation? We don't need to look at depreciation, right? Yeah, because that depreciation is now sold, right? This 1.5 was here, 1.5 over here, right? It's already being depreciated, right? So we don't need to worry about that, but we actually need to take care of that 1.25, right? So that's the total investment that we need to consider, right? So this will give us what's this? 3.75 minus 3.5 over 4 minus 1.25 plus 6.5. So what we will get is 2.7% ROI. All right. Let's take a look at C. If Oscar acquires a new machine and it operates according to specification, what ROI is expected for next year? So we are looking at next year information, right? So let's see what is promising us. Okay, would expand the division. Obviously here, right? LSI has 6.5 million for assembly machine that offers significant improvement over the equipment Oscar bought at the beginning of the year. The equipment would expand division output by 10% while reducing fixed cost by 5%. Okay, it would depreciate for the accounting purposes over a 3-year life. Depreciation would be net of 5,000 salvage value of the new machine, right? So here, it gives us the promise of what's gonna happen next year, right? So for this, we need to figure it out. The formula over here, same thing. Accounting income, we're looking at next year. And then investment next year. Okay, so let's figure out what our next year income gonna be. Right. A lot of times students get confused or get scared. Oh no, I have to figure out next year income. Where do I start? It's actually very easy. If you think about the next year income, where did it go? Over here. Its formula is already given to us here, right? That's the income statement over here. It's already given to us. So we just follow the same thing. Right, so what do they have? Over here. They have sales revenue. And then they have operating cost. And here is the variable cost. And then fixed cost. Okay, and then have depreciation. Okay, of new and other. Okay, and then that will give us the operating profit. Okay, I don't like the word operating profit, but whatever. So over here, the sales revenue, what does the company promise us? The sales revenue is going to up 10%, right? So we have 16 mil times 1.1, right? Up 10%, right? And if this is going up by 1%, 10%, we also know that okay, the output, because the output goes up by 10%, variable cost also goes up by 10%. So that's 2 million times 1.1, right? Because the sentence is here, right? Would expand the division output by 10%, right? So the fixed cost down by 5%. So we have 7.5 million times 0.95, down by 5%. So let's figure out the depreciation. So the depreciation here is we have 6.5 million minus the residual value 0.5 over 3 years. So that's 6 million over 3 years. That's give us 2 million of depreciation. And then other depreciation over here is 2 million. And other depreciation is the same thing, 1.25. Right. So here what we get is let me just write down the number here. Okay. 17.6 million, and the variable cost is 2.2 million. What? Question? I heard something. Here is 7,125 million. Okay, so minus depreciation minus other depreciation, put all things together, you should have operating profit comes down to 5.0. So that's the next year income. How about next year investment, or what we call the asset? Okay, ROI, right? Return on asset. So we have the 4 million. Okay, this the asset from last year, old one. Okay, and then what we need? Change, right? What has changed over these 2 years? So we have, this is asset and a plus change. Okay, to the net asset, right? To net asset. So what has changed over these 2 years? Okay, so how many times do we depreciate this 1.25 over here? Has depreciated twice, right? So we know the other depreciation okay, and then other change is that we bought 6.5 million. That's a new machine. And then we also depreciate this machine by 2 million. So we know next year's net asset is this year's current asset, this year asset, right, plus the changes to the asset. So we need to depreciate 1.25, right, times 2. 2 years of other equipment's depreciation. And then we also bought a new machine of 6.5 million. But this 6.5 million also need to be depreciated by a year. So that is 2 million. Okay, so this will give us, help me out here, what's this comes to? It's 2.5. Right, over here, 2.5, 1.5, 1.5, 8, 6 million, right? 6 million. So we know this is the next year asset. So if we put 5.025 divided by 6, okay, we get 83%. Right, so what does that mean? So if we change the new machine next year, we're gonna have a better ROI than stick to the existing machine of 60%. That's the decision I'm going to make. Yeah. Because it's 2 years, right? Now we're looking at over here, 4 million, right? And then this is year 1, and this is year 2, right? So year 1 depreciated 1.25, that's current year. And then what we want is the end of next year result, right? So we depreciate twice, year 1 and year 2, right? Because the machine is purchased here, right? Somewhere here, 6.5 million added. And then so this 6.5 million would be depreciated only once. Okay, so you see that the reason why I said it's going to be more difficult, this is because the calculation is very easy, plus and minuses, but it's the professional judgment, you know, what account, what doesn't count, right? So that's usually the hard part of managerial accounting, or because you need to have a solid foundation background, right? So for questions like this, if you don't have a solid foundation from your 100 and 101 calculating depreciation, then you may miss this, right? And if you do not understand the concept of a changing in net asset, this is actually changing new asset, right? Change in net asset, right? So if you don't understand this, even you understand the ROI formula is accounting income over investment, right? You may have a hard time figure out the right formula, you know, to come to this investment number, right? Because you forgot to consider the change in your net asset. Right, so let's take a look at next question. So Oscar Clemente is still assessing the problem whether to acquire LSI's assembly line. He learns that the new machine could be acquired next year, but if he waits until then, it will cost 15% more, and the salvage value would still be 500,000. So other costs of revenue estimate would be apportioned on a month-by-month basis for the time each machine, either the current machine or the machine Oscar is considered is in use. So fraction of amounts can be ignored, ignore taxes. So when would Oscar want to purchase the new machine if he wait until next year? So this is a this is kind of the question doesn't really require calculation, right? Because just think about it, the machine is going to result in a positive net benefit. So he would want to acquire it as early as possible, right? So he could reap the benefit a full year round, right? Because the later he does, right, it's gonna cost 15% more. So you don't really need to calculate to understand that the earlier he goes into that, the better, because the old ROI is at 60% and the new is at 83%, right? Okay, and then so the later he does this change, right, the more depreciation is gonna eat up with the old machine, because he have to dispose of that old machine, right? Remember that $5 million machine? So if it did it later, the $5 million machine probably will eat up even more depreciation. So like on a month-by-month basis. So just like cars, right? If you have a car, you're not using it, just sell it. Because every month you keep the car there, it's gonna eat up depreciation. The value is gonna go down more and more. So what other costs must be considered in considering making this decision? So the relevant cost is the lost bonus this year that this machine purchase can make to the to this year's benefit. Because you see, if you change this machine earlier, right, you are able to reap the benefit earlier, right? And so that's usually what the consideration you must pay into. And also the second one is the change in depreciation. Okay, the more you waited, okay, the more money you have to dump into depreciation, right? So this number here, I included here just to let you see, right, reflected back to change of net change of asset over here. Over here, did you guys see that? See, the later he changed this, where's the income change? Oh, over here, right? Where did it go? Over here. The later that this decision is adopted, the revenue effect is going to be delayed. Okay. The volume effect is going to be delayed. Okay. And then the depreciation cost, okay, that will affect this old machine is also going to be changed because you have to dispose of your old machine later down the road. You see? Then it's not just 2 years of depreciation. Let me hear where is that year 1, year 2 stuff. Over here, right? Year 1, year 2. If you dispose the old machine too late, the old machine's depreciation is 1.5. So if you deposit it later, then this depreciation will add to this over here on the month-by-month basis, right? So the idea is we dispose of, let me just write it down to make it clean. The ideal situation we're proposing happens here, 6.5 million. But with this 6.5 million, that means we will sell that 5 million machine, right? And with this 6.5 million change, what will change is our revenue goes up, right? Okay, and then the variable cost goes up, but the overall ROI goes up, right? But if we were to delay this change, okay, then we won't be able to benefit from this revenue effect goes up by the full year. And on top of that, this 5 million machine, right? The depreciation of this is 1.5. It's already incurred here, right? But the 1.5 depreciation, if you sell it later, this will be 1.5 over 12 plus 1.5 over 12 plus 1.5 over 12 every month. You see, that's the depreciation. Seems same thing as that you keep that old car in the garage and don't sell it. Every month, right? That depreciation eat up the machine, right? So that's just how it is. It's actually very easy to consider. Okay. Right, so next question 48. Refer to the facts in 1446. Assume that Pitt's performance measure and the bonus plan are based on residual income. Instead of ROI. So we want the residual income. Right. So the residual income, then we have to consider is the rate of return. Right? Because remember residual income, what we're looking at is the income minus rate of return times investment. Right? So let's say performance management ratio are based on residual income instead of ROI. Pete uses the cost of capital of 12% in computing residual income. So their ROR, the rate of return, is 12%. So we know what the formula here we are looking at is 1 plus 0.12. So what we are looking at is the sum of the investment times 1.12. Right? It's like, for example, if you invest in $500 and you want the rate of return, let's say 12% rate of return, right? So what you will need to do is 500 times 1.12 or 500 times 0.12 plus 500. Right? That would be the sum. So this is, either way you can do that, but it's just 1 times 1.12 is much faster. Okay, so you have this 1.12 times the sum of investment. So let's get to that number. So we already have the accounting income. We know this accounting income is given us at 3.75. Okay, minus the rate of return times the total investment. So that's just, we only need to worry about the total investment. Originally is 4 million plus the 5 million, okay, minus the first year depreciation and minus the first year, the other depreciation. Okay. So the RI, residual income, for the first one will be 3 million. So calculate out 3 million. Oh, no. I'm sorry. I was thinking about something else. Yeah, yeah. It's just the 0.12. Sorry, my mind is somewhere else. Yeah. What I was thinking is the total of the new asset. I was thinking about something wrong. I was tired. Just the rate of return over here, 0.12. The answer will come out to 3 million. And section B, Ford's residual income this year, if Ford acquired a new machine, it's the same thing, right? So on the income side, we have 3.75 minus, right, the purchase of a new machine and the getting rid of the old machine, right? Because the loss on the disposal. So the loss on disposal is $5 million machine minus the 1.5 depreciation. So the income, the accounting income is 3.75 minus 3.5. Okay, that would be 0.25 million. Okay, and on the other side, the rate of return 0.12 times the new machines and new investment, the 4 million our original investment minus the 1.25. Sorry. Minus the 1.25. That's the other depreciation. Okay, and plus 6.5 of new investment. new machine. Okay, so what we get here is I think this comes to a negative number, right? It's a negative 860,000. Okay, so if we go with the new plan, right, the first year, we're gonna show a negative residual income. Okay, and item number C. Item number C is the same idea. We lay out the net income. Yeah. Okay, positive. Are you sure? Zero point 0.25. 0.25. What did you get from here? Okay, let's not do 0.2. Okay. Let me get my right, let's see. So over here you have 250,000, that's 0.25 million, right? Minus 0.12 times 4 million minus 1.25 plus 6.5. Right, let me see. Let me get from my calculator here. Yeah, 9.25 times 0.12, right? So this is 250,000 minus 1, right? And give you negative 860, right? Residual income, negative 860. You see that? All right, let's figure out section C. C is the same thing that we need to figure out the net income, the new net income part. So just go back to the sales is 16 million times 1.1, right? And the costs, V variable cost, because the volume goes up, so is 2 million times 1.1, and the fixed cost down by 5%, so is 7.5 times 0.95. Right, and this we would minus the new depreciation, new machine New machine depreciation is calculated 6.50 minus the 500,000 residual value divided by 3 years useful life. So each year depreciation is 2 million. And the other depreciation, 1, 2. So we already done this, right? So the new net income is 5.025. This part we already did. So what we need to do is 5.025. This is the new income and minus the ROR times the asset. So the asset is the 4 million. Okay, minus the 2 years of other depreciation. Sorry, 4 million. Uh, 1.25, right? 2 times the 1.25, right? And plus the new machine, and minus the new machine's depreciation, 2 million, right? Okay. So just calculate this out. So that would be 4 plus 2.5 plus 6.5 plus, no, 4 minus 5 plus 6.5 minus 2 equals to 6 million, right? So it would be 5.025 minus 6 million times 0.12 equals 72, right? And that will give us 4.305. So that would be next year residual value residual income, not residual value, residual income will be $4,303,000. So even though this year we got a negative, right? But next year's residual income will go up to $4 million, right? In comparison to state course, the residual income is only 3 million, right? Did you see that? Yeah. And so changing to the new machine in the long run may be better because it increased our residual income by $1.3 million, right? Okay. Right, so let's take a break. We're going to come back to the next chapter on transfer pricing. So I'll see you at 8:30. Is that enough? No, actually, I'm very hungry. I don't have any energy. Give me 15 then. Let's come back at 8:35. I'm really kind of exhausted. I need to get some food. 8:35? Yeah? Good. Can you get my computer for me?
没有，不接不接。第几个？那个不弄啊，那不弄就可以。OK。
旺旺。
Hey, that was a growl, not one one.
One one. Can you buy something in Japan for me? Like miso shiru no fu.
Today already.
Oh. What do you thought like when I say some castle phone stuff? Huh? Pen. Yeah, pen. Pen 買って、pen 買って。pen 買って、お願い、買って、お願い。
室ついてへんが。
看一眼，哇，看一眼。 All right, let's come back to class. Hi guys. Hello. So are you guys back? Abba, Jie-Ying, turn on your video so I can see you guys. If you come back, just turn on your video. All right. So remember last hour we talked about Ford and F-150 going to announce a very important new model, and the reveal is scheduled around 4 p.m. Pacific Standard Time, right? And let's take a look at Ford stock performance. Just today, today's price, right? Look at that. At about 12 p.m. today, it was trading at a 5.89, right? And then at 4 p.m., it goes up to $6. So what that means is the market actually think, oh, this is pretty good, right? Oh, this is the backbone of the new economy. Yeah, these times are Eastern Standard Time, and we're talking about the Pacific. We're looking at the Pacific Standard Time here, right? So it's been over here. See, close at 7.59 p.m. Right? So the market think that this new announce is gonna make pretty good investment, right? So tomorrow it's likely that to go up a little bit more. I would say like 10-15 cents, no more than that, and then it will stabilize, because it's this kind of effect, we don't know how much it will go, but this pretty much will tell us what the market, what the investors think the economy next year will be, because this is considered, the Ford F series is considered one of the backbone of the US economy. It's that important. So this is one of the stock to watch. You know, if you want to invest in stock market, invest in this kind of company. Look at that, $6 a share. You know how much Tesla is a share? $1,000. You can buy like $100 and buy 20 shares. Okay? But with the Tesla, $100, and they You can't even own one share of the company. Yeah. Right. So it's actually quite interesting to look at this. I didn't buy any Ford stock. I didn't because I don't necessarily believe in that company long term. So, but if you guys want to invest in Ford, this today was actually the good time to do that. All right. So this hour, we're gonna take a look at one of the most important part of cost accounting. It's called transfer pricing. Okay. So on the surface, you may think that transfer pricing, what the heck that is? But transfer pricing is actually, where's my background? The way how large international business, they were able to make a lot of money and hide the money offshore. It's the technique that Apple use, Google use, right? And if you want to understand how this transfer pricing work, there's actually a very good article over here. They were published back in 2012. They show you graphically how this thing work over here. I posted in the chat area, so you can get this link directly. The technique has a special name to it. It's called the double Irish with a Dutch sandwich. Okay? If you search this term, double Irish with a Dutch sandwich, just on Google, what do you see? That the double Irish with a sandwich, with a Dutch sandwich definition, right? Google says it will no longer use double Irish Dutch sandwich, right? And double Irish Dutch sandwich tax saving, how it works, right? And this was one of the methods that Apple uses to hide its cash and to reduce its tax savings, the tax liabilities in other places. So let's see how it works over here to give you a good idea. Right, so it starts here. The US consumer buy things, right? But the actual flow of goods, you see over here, the manufacturing subsidiary is actually the flow of goods flow from China to US consumers and the flow from the US, from this Chinese manufacturing arm to overseas consumers. But the flow of value, okay, it went all over the world, particularly go to some Irish subsidiaries here. Because the things here that is really important, because there's special tax privilege between Irish and Netherlands. So when they do that, there's no tax in between. Okay, so eventually they transfer the profit over to, let's say, Caribbean or other tax haven. There's no tax, 0% tax there. So what that means is that instead of you are buying from Apple, right, that company, but actually Apple is buying this iPhone from a subsidiary in, let's say, in Irish company. So what that means is here, let me show you, using a worksheet over here. Let's say you as a consumer, okay, you want to buy this iPhone from Apple, okay, and this price, let's say $1,000, okay, and we know that Apple's cost, let's say at 500. Okay, so supposedly what happened is that for each device sold, Apple has to pay $500 and times the tax for it. Okay? So the transfer pricing setup is, oh, no. It's not $500. We actually bought this iPhone from another subsidiary, and the cost to us is actually 900. So the tax liability to Apple in domestic state, in the domestic US, is actually $1,000 minus 900 their cost, and Apple claim that the profit in United States is only $100 a piece. Right? So how they work is this: they set up a subsidiary in another country. So even though the goods only flow from China over here to US consumers, the US consumer that you are paying, a lot of the profit actually shifted to an Irish subsidiary. And that is in the end goes to a Caribbean and other tax haven. Okay? So in this way, they pay no, like virtually no tax at all. So how this game is played, even though it has a funny name, double Irish with a Dutch sandwich, but the game behind it is the abuse of what we call transfer pricing. Okay, so when it comes to understand international large conglomerate or large business, transfer pricing is one of the most abused part of international trade. Okay, because as a large company, you can set up subsidiaries everywhere. Okay, even though the goods only shift from China to United States, but on paper, okay, the ownership of the goods have to switch to many countries just to avoid tax in different area. Right. So today's chapter, this chapter, is where we're going to take a look at how transfer pricing work. Right? Why does it matter? Okay, and how a company used to abuse this type of situation. Right? And that's why that I also chosen this transfer pricing to be your actual assignment, because understand transfer pricing give you a lot of weapon, right, to work in, especially this market, because in this market in the Bay Area, a lot of firms, they actually use transfer pricing mechanism, right, to offload the benefit to offload the profit to somewhere else, so they don't need to pay tax over here. Right? It's incendiary, it's like, it's bad. It's one of the part, but it's also one of the things that people don't understand, how this game is played, how Apple are able to hide their cash and pay so little tax, is this transfer pricing. And you learn the transfer pricing give you a huge, I'll say, advantage over other accountants don't understand how this game is played. And if you want to, let's say, work in the accounting firm, if you want to be able to audit international firms and big electronic firms, you have to learn transfer pricing. Okay, so the transfer pricing, so what that means is, first we have to understand what is a transfer price. Okay, so transfer price is the price that one subunit of a company charge for the service it provides to another subunit of the same company. Okay, so graphically, it looked like something like this. This is a huge company, big umbrella called Apple. Right? So under Apple, what happens is that we have a subsidiary to make Macintosh OS, Mac OS, OS X. Right? Okay, over here is the phone division. Right? So if, say, Apple over here, they make a phone, right? How do we make this division profitable, right? So in the old way, you may think, oh, this Mac OS is a service. They don't make any money. They just make it's just a bunch of programmer. But The setup is what if I make this a subunit of the company? It's actually company beneath this, right? Beneath Apple, and they charge this phone department for every software made, for every software you use, will pay us $50. Okay, for these Mac OS, every copy, right? So what if I set up this this division over at, let's say, Delaware or Nevada? Why over there? Because they don't have corporate tax there, right? So what happens is this, okay, $50, that's fine. What if $100? What if $200? You see? So you switch the profit of the company, the firm, to other places, just using this price that you charged other subsidiary. And games like this can be played over and over and over. That's why Google, as a company, they changed to a kind of holdings company called Alphabet.Inc. and set up different subsidiaries, and they play these transfer pricing games over and over and over. Why? Because then they can set up, they get a scheme to save their corporate income tax. Right. Okay. So transfer pricing is the determination and the exchange price for intra-organization transfer of goods and service. E.g., like over you see here, Division A sells, okay, sub-assemblies to this Division B. That's one way. Or in this case that we showed here is actually the sale of a software, right? It can be many things that you set up, right? Okay, product can be final product sold, okay, to outside customer, or intermediate product like components, right, or parts within the company. Like for example, if we say over here, let's say Ford. Ford over here, instead of making cars, trucks, let's say this is a truck. We know truck needs an engine, right? Right? So what if I just set up a subsidiary making engines? Okay, making engines.inc. Okay, so once this engine is made, I sold to Ford, my parent company. Okay, so when Ford said, oh, the cost of F-150 is engine plus other stuff, right? So if the engine's price goes up, what happened? The revenue reported by Ford goes down. Right? The profit reported by the Ford goes down because the cost goes up. So Ford pays less tax because the revenue is hidden. The profit is hidden over here at engine.inc. Okay? Over here. So that's one way to look at these things. It can be a final product. Okay? So Ford can, okay, we made this Ford 150, F-150, done, the final product. But what happens is no, instead of selling Ford by Ford directly, and Ford may start a company that's just say the Ford Financing, okay, the Ford Leasing Corporation, right, and sell the Ford 150 to the leasing company, fordlease.org, Ford Lease Inc. Okay, so then the question is, when Ford sells this finished good to Ford Leasing Company, what's the price? Right? That depends on a lot of factors, right? Whether you want to hide the profit over in Ford, you want to hide the profit over in lease company, right? How would you like to do it? It's completely depending on Ford. So as you can see here, transfer price can be manipulated many ways, right? And usually this kind of game is played in large corporations, right? Or in what they called quote unquote holdings company, right? They just hold stock within different companies and they move things around in different tax haven or but because of different liability of the tax liability is different in countries from country to countries, or they want to prop up subdivisions, things like that. Right? So transfer of product and service between business unit is the most common in firms with a high degree of vertical integration. So vertical integration means like Ford, right? So not only they do design, they do R&D, okay? They do what? Assembly, okay? They make the final product, and then not only final product, they do sales in perhaps the dealerships or leasing company. So there's a high degree of vertical integration. So if the transfer pricing is set here, set here, set here, set here, set here, okay, they can manipulate this transfer price to determine where is the place they want to put the profit in. Okay. So even though you see that you're paying $39,000 for the F-150 truck, right? Okay. With the transfer pricing, what the company can do is they can hide the profit anywhere within the company. Okay? It's very evil. Yeah. The one who's good at this game wins. Right? So that's why so many companies. Do you guys know the Halliburton? Halliburton? As one of the most evil company in the United States. It's a private military arm. Yeah, it actually is. The military contractor, Halliburton. And the Gulf War, right, benefited that company so much to the point that they moved out of the United States and then start their company in UAE. Yeah, you're talking about this company, right, benefited from Iraq War, right, and all the conflicts in Middle East, right, and then go ahead and move their corporation to United Arab Emirates. Yeah, so they can not pay tax. Oh, that's the most evil thing. You know, they get money from the taxpayer, from us, because you see, when you're talking about war deployment, right? The people who cooking for the soldiers over there, right? They are not necessary soldiers. They are contractors. They are employees paid by these kind of war machine, like Halliburton, right? Those chef, those cleaning personnel, they are like that. They are Halliburton employees, contractors, military contractors, right? So you think, okay, fine, you make some money. And you make some money, pay your tax in the United States. And then, so the people who live in the United States benefit from it. No, they move their company offshore. So actually they pay no tax. So this kind of a bloodsucker. Now we pay all this tax and then the DOD pay them and then go ahead to other country. Huh. Evil. Yeah. What? Amazon? I didn't I didn't study Amazon. I didn't spend time study how Amazon did it, but it would be very interesting because how company does this type of accounting scheme, we don't really know, because this is internally the managerial accounting come into play, right? And a lot of these tip and tricks we don't see. And I haven't studied Amazon's how they did it, but it's quite interesting. I will make an effort to study how Amazon does that too. Right? But I know Google, how Google did is by manipulating transfer price. I don't know how Amazon did it. Yeah, but I'll study that. Okay, so if we look at this way, a decentralized firm, okay, so they have a headquarters somewhere. They have an engine LLC, they have an HR, right? Somewhere. Let me see. Hold on, let me bring okay. So they have a small no-bill corporation, they have a bold corporation, they have the export LLC, they have an HR and service company, right? So what it does, this company, right? They can set up transfer price, like we said earlier, the engine department, no, the engine LLC or the engine company, sell the engine to export, sell the engine to snowmobile, sell the engine to boat. Okay. So the idea is how much is engine is supposed to be. How much it is engine price is supposed to be. Right? Okay. So if the case is that we intentionally make engine cheap, okay, it only costs $1,000 to make this engine. Should we sell this cheap engine to snowmobile at $1,000 at cost? Should we? Can we? Or if we were to sell to two companies, can we sell snowmobile company at 1,000 but the boat company at 2,000? Can we do that? Okay. Or when this snowmobile and the boat company, when they have finished the product, okay, they sell to domestic customer or to export, right? How are they gonna set the price? You see, because what we're seeing here is revenue minus cost of goods sold, right? Minus period expenses equals to net income. Right. Oh, equals to operating income, I'm sorry. Operating income. And then we have to pay tax on this. Right? So if the situation is that the engine company is making a lot of operating income, okay, and in a high tax area, it may be a good idea, right, to offload this extra income to other areas, to snowmobile or to boat company, right? So to make it as if this engine company is not making any profit at all, right? So usually the case like this engine company also sell engine to third party. And this engine is so good they're making a killing, right? This engine is only actually worth $5,000 a pop, but only $1,000 to make, right? Okay, so the idea is they are making so much money from third party, okay? They can provide this to other companies at cost or at a certain price level in order to offset, right, the actual profit that they carried by selling to third party. Okay, so this trick, you know what? Which company is doing that right now? Tesla. Tesla's doing that. How does Tesla do that? So Tesla, what the Tesla is trying to do, this is, let's say this is a Tesla car, right? So Tesla right now, here, that's the battery. It's a different subsidiary. Okay, and then the roof, the solar roof they're trying to do is a different subsidiary. Okay, and for Tesla, the Cybertruck, you guys know Cybertruck, the ugly thing, you know, like a Lego. That Cybertruck exterior, they are from SpaceX. So the chances are that Tesla is going to manipulate the transfer price in some way to hide the profit somewhere, or to pad the profit in the in Tesla, or to pad the profit in SpaceX. Right? Any way they want to do, it's very easily manipulated. Right? So let's see. So what are transferred? It can be complete product, intermediate product, service, or intangible properties like patent, trademarks, and others. And usually, the most abused part is this, intangible properties. Why? Because there's no market price out there. Right? You don't know. How much you want to pay for this patent is purely, right, based on if you company want it or not. Right? Unlike a complete product, there's actually rules set up. They said you can't go below market price too much. Right? Like, so for example, if you are selling F-150, then the MSRP, let's say 38,000, and then you can sell this to Ford leasing company for just $1. You can't do that. Right? There's certain rules and regulations. You can't set the transfer pricing too low. Right? So this is what we called the related party transaction. Okay? Because the company are not acting in arm's length. Right? So arm's length company is, you just look at it visually. So arm's length, right, talk to the hand, kind of like that. No, arm's length. I'm not getting too close to you, stay away. So that's why we call it arm's length transaction. It's yeah. Don't get too close. Okay, so these kind of transaction we call the related party transaction. And when you become an auditor, this is usually the big part to audit, related party transaction, because there will be transfer pricing manipulation hidden, okay, inside, and some of them are even illegal. Right? Okay. So type of company that would use for transfer pricing: family business, usually a big one. Son owns a subsidiary, daughter owns another subsidiary. Right? For example, let's say, very sinister over here, this Trump family, right? So they have what? They have a golf course somewhere. They have a hotel somewhere. And Ivanka Trump have a fashion business, selling clothes. Used to have. It's gone now. And nobody buying it, that's why. You guys know that? Yeah, it went belly up. So this is fashion business, and what else? And they have, even worse, they used to have the Trump, that how do you say, nonprofit, and the Trump Foundation. So if, let's say, Ivanka here. Okay, so Ivanka here want to have a conference done, right? Okay, so how much does Ivanka pay Trump Hotel? How much? We don't know, right? Because this price can be manipulated. If the Trump, this thing is losing money, right, we can set this price very high. And Ivanka, because, oh, this is daddy's company, daddy's hotel is in trouble, okay, I'll pay more to help daddy. And Trump always in trouble with his hotel, always. It's just like a rule of thumb, Trump and the hotel, right? And how about the this company over here, or over here, they want to send gifts to loyalty programs, loyal customers, right? They may buy stuff from Ivanka, right? And buy clothes, buy shoes, and buy whatnot. Okay, if you sign up, you get the Ivanka's shoes or whatnot, right? So you see, family business, they can abuse this a lot. And then with a foundation, a nonprofit set up, Do you know how transfer pricing is abused in nonprofit? It's very easy. Let's say Ivanka has things that she can't sell. She can't sell. What does she do? Donate to Trump Foundation, right? And write off as a donation, right? And over here, even this Trump Foundation want to have a conference, use this hotel. You see? So it's when it comes to business, and that's why that Trump, right? He never want to release his tax. There's a reason behind it. It's sinister. It's evil, right? You see this guy, touting to be this businessman, but the number one reason he does not want to share is because it's not because how evil it is. He doesn't care that part. The number one reason he doesn't want to share is because he doesn't want people to realize that he's such a big failure. Yeah, that's the number one reason he doesn't want to share. And trust me, it really is. Right. So family business or international conglomerates or strategic integration like merger and acquisition, that's Tesla doing right now. Intentionally buying things, right? Or intentionally merge several companies, like they buy up the Solar City, right? Okay, or large service organizations or vertically integrated company we already talked about, or sometimes can be horizontally integrated. So usually how you work out transfer pricing problem, right? And I like to do it visually, is to do these things, to track how things move. So if the setup is like, okay, you have an engine SBU, and there's a boat SBU, snowmobile SBU, draw it out. Okay, so you can write the price. Clear. Okay, or the subsidiary SUB1, SUB2, SUB3, right? So you can write things out. This engine down at 1,000, this engine at 800, right? And then they can perhaps sell this finished goods to another subsidiary 3, right? At a certain amount of money. And then sometimes you have extra information like tax rate here at 18%, tax rate here at let's say 24%, a tax rate here at 0%. So you can track things visually when you try to solve the transfer pricing problems. Always try to do it visually, because if you guys have probably experienced so far right now, right? When you read a long question, there's so many numbers, so much information floating around. It's easy to lose track, and especially transfer pricing. When you read the transfer pricing, the questions is so complicated sometimes that you just lose. It's like you don't even know what you're talking about, looking at anymore. And that's why also transfer pricing is so difficult to investigate and to audit, because you literally can lose in the maze of the transfer pricing that the circle that company set up, right? You just don't have enough time as an auditor to figure out what is really the game company is playing. Right? Okay. So sometimes the transfer pricing are not necessarily evil. Okay, they are set up to evaluate the performance, to motivate the managers to do certain things. Okay, because you see, if you want to motivate a manager to sell more product or to lower the prices, you may set the transfer pricing in certain way to motivate them to do that. Like, for example, to provide an incentive for manager to make decisions consistent with the firm's goals, or to provide a basis or fairly rewarding managers. Okay, and for specific international issues, usually is to minimize the custom charges. Right. So, for example, if let's say over here is Japan, here is the United States. So you know what Trump did, right? Trump imposed a very, very high custom charge for any goods coming from China, or at a period of time from Japan as well. So if you set the transfer price too high over here, let's say this engine at $1,000, then you will have to pay very high custom charge, right? So what the company do is, okay, instead of $1,000, right, you change the custom charge, that's lowered to 400 or lowered to 800, right? So they are paying custom charge on 400 instead of paying custom charge on 1,000, right? So at the end of the day, for the company, it's the same thing, right? You want to impose custom charge, I would just hide the profit somewhere else, right? I will hide it here and hide it there. And what Trump did is he hoped that this transfer price will end up in the United States, right? So the United States, with at that time, he also simultaneously lowered the corporate corporate tax rate, right? So what he's trying to do is try to have corporation to put income over in the United States. And then put income in the United States with a low income tax rate, you know who benefits? Shareholder. Because you see, you are not paying that much tax, so those additional income goes to shareholder. So that's the game he played. He trying to think this, okay, I will use all this game to make the stock market look better and better. But the problem is that this kind of game you can play only for so long, okay? Because in the end of the day, I'm going to show you in the next few slides what happened at the end of the day. You know, why this game you cannot play it long term. Right. So also have sometimes it's a currency restriction. Right. Okay. So that's explain this. Do you guys know this company? Yes. So for some of you can read Chinese characters, kind of unfair, but you know, but most of you can read from this logo, right? Yeah. This is the Mitsubishi Corporation. Okay. The Mitsubishi Corporation is one of the largest Japanese conglomerate, right? And Mitsubishi Corporation is for so long. It's actually the company. It's about 300 years old. Yeah, that's how old that this company is. And the Mitsubishi Corporation is very important company for Japan because before World War I, before World War II, Mitsubishi Corporation is the war machine of Japan. They make boats, they make airplane, they make the aircraft carrier, they make the tanks, they make the rifles, they make everything, right? So at that time, before World War II and World War I, what happens is that this company gets so big, they were able to interfere the domestic politics, right? So this company, in hope to expand their operation globally to make more money, they actually interfere with the military decisions to have the military become sort of expansionist scheme. So after World War II, the Americans are not stupid, right? So one of the MacArthur's mission is to break Mitsubishi Company apart. Yes, that's one of his job. So, okay, I'm giving you this job to break up this Mitsubishi war machine so no company can be like that anymore, right? To have the type of power to make a country go to war, right? So MacArthur go ahead and did that. But what happened without anybody's knowledge back then is, yes, MacArthur succeeded. He indeed broke Mitsubishi Company into so many different smaller companies, right? But back then, what we did not know is MacArthur created the first conglomerate and start to have this kind of transfer pricing issues. Let me show you how this transfer pricing issues go to the max. So what happened with this type of company is originally they have a big company. That's how Japanese company used to work. It's a big block. One single company, right? Controlled by usually one single family. Okay. Used to be like that. So General MacArthur came in with his big, right, pipe. You know, MacArthur liked to use this corn pipe. It's very, very interesting, just a big stock. So he came in to broke it into several parts. Smaller companies. So now there's a Mitsubishi heavy industry make those diggers, right? There's Mitsubishi cars, Mitsubishi airplane, Mitsubishi boats, right? So what MacArthur didn't see is these companies started to become related company to start abusing this type of transfer price. So what happens here, for a very interesting example, that the company that I work for over there in the past is this one. Okay, and it said the Mitsubishi is the Eastern Japan, and here Itochu Corporation is the Western Japan, the competitor part with the Eastern Japan. So how they do that is here. Let's say I'm here. Okay, what I do is I do IT audit. Okay, so I provide IT audit services, and I can sell IT audit contracts, right, to as many people as I like because I'm a company. But yet, in the same time, when subsidiary A, subsidiary B, subsidiary C, subsidiary D need IT audit, I get a contract. I get a contract. I get a contract. I get a contract. And these companies, if they want to source out this IT audit, they can't do that because I'm one of the subsidiary, right? They should have me do it, right? So in one way, they save cost on IT audit because they just have a capable subsidiary to do the work for everyone. Okay, in another way, they can dump. For example, if I'm suffering a low business, right? So they can dump their excess profit to me, excess profit to me, excess profit to me, right? So when you have so many subsidiaries here and there, the situation becomes if this subsidiary C, let's say, is a brand new subsidiary, what they do is just say the office supplies. This is a new office supply subsidiary. Right. So they set up this brand new subsidiary, no profit, okay, no nothing. So what they did is require every company to purchase office supply from this subsidiary. So very, very fast, they can prop up this subsidiary, right, in a very short amount of time, just by the power of the conglomerate, right? Okay, so let's say if this subsidiary here have $1,000 operating income, okay, we distribute this $1,000 over here, 100 over here, 100, to the point that this subsidiary shows 0 operating income, so pay no tax, right? So with all this, they keep setting up subsidiaries that they can hide this profit anywhere they like, because there are, like Mitsubishi Corporation, they have like about 3,000 subsidiaries out there. Yeah. But the problem at the end of the day is that if I keep doing this as my IT audit subsidiary, if I keep doing this for the subsidiary, yes, at my company's perspective, my own company's perspective, yeah, it's pretty good. I get paid, I reduce tax, and then every subsidiary arm doing this way. But the problem is that if you look at corporation as a whole, what happened? You're just making things here and there because the money does not come unless you make out money from outside of the firm. You won't see it. The company as a whole, even you pay no tax, right? Even you don't do anything. So if you don't get service from outside, all the profit in the big conglomerate perspective is fake. You're just transferring here and there, transferring here and there. Because the real profit is when you make profit from outside the company. So me over here, let me clear this here up. So me over here at the IT audit, Okay. Okay. So on my company book, perhaps I can see job 1, job 2, job 3, job 4, all those, and give me a very good profit. But if all this job is just intercompany job, looking at the corporation, the big conglomerate as a whole, it didn't make anything unless I go out of the corporate umbrella and bring in money, new money, fresh money from outside. Okay? It's kind of like this. Let's say you have 10 bank accounts, right? And you keep moving money between bank accounts. Oh, this bank account give me a little bit more, this bank account give me a little bit. You keep moving money from bank account. If you are not making any money, you are not making any money, right? You don't get anything unless you go out, right, to make actual money, real money from outside of the conglomerate. So the long-term effect of this kind of setup is you have a big corporate umbrella that sheltered so many subsidiaries, and all they care about is saving tax within each other and live comfortably just by enjoying the intercompany contracts and intercompany transfers, right? And they lose the desire to go out. Okay? So what happened in Japan long term? Japan used to have the best cell phones in the 90s, right? Before us. They had in the 90s, they already had phone, can do SMS, can take pictures, can play music, can watch TV, and all that. Right? They used to have all these good things, but they refused to go out. Okay, so now a lot of these Japanese industries are suffering, right? Because Korea. Okay, even though Korea's many industry runs in a conglomerate like that, but Korea, the government encourage Korea to sell outside of Korea, because they know this way will not work. The Japanese conglomerate really kill the Japanese companies' international competitiveness because nobody is interested. Okay? They use the tax saving as one of the metrics in performance evaluation. Right? That's all they care about. When I was there, it's like, oh, you pay too much tax. Nah, you're stupid. You should allocate this price somewhere else so you don't pay don't pay tax. So it's actually pretty bad. So you see, transfer pricing, if you abuse it too much, actually is not good for the company at all, right? Because you sort of discourage your employees or encourage your subsidiaries to have the courage to go out and make a killing outside. Okay. So you see how transfer pricing utilizes sometimes is to save on taxes, okay? Sometimes to enforce control of several subsidiaries, okay? So if you don't act properly, right, I'm not going to allocate contract to you to force a subsidiary into the line. Okay? So you see, in there, it's like, no, maybe these companies say, no, I don't want the intercompany transfer anymore. No, I don't want to hire Mr. Tian Li's IT audit service. He sucks. No, he just come here and sit there, drink some coffee, eat some cookies, and he's gone. He actually didn't do anything. I want a real IT audit, right? But then the corporation, because we want to save tax, right? We may say, no, you have to use his service. And they use this kind of intercompany to enforce control. Right? And sometimes it's anti-competitive. You see, if one of the subsidiaries, like we said earlier, is selling office supplies, if it's selling office supplies, and this office supply we know have to make profit outside of the company. So how do this office supply compete outside the company is to making price low, right? But how do they make price low? Well, if the intercompany transfer to this office supply store, the price is high, they can offset the loss from this low price to intercompany, right? So I can use this scheme to make this office supply company very, very competitive, right? To kill other competitors in the market, right? Same thing if I see earlier the example of engine, right? Okay, so if I have several subsidiaries, let's say subsidiary 1, subsidiary 2, S3, S4, S5, and an outside customer over here, customer 1, right? But then I have competitors over here, right? Competitor M, right? So competitor M is offering an engine, okay, at $5,000, okay? And I want to force this competitor out of the market. So I'm offering my customer the engine, almost the same engine, at 3,000. I'm taking a loss, right? But how do I plug this hole? I make the transfer price high over here. All the subsidiary here, they pay a higher price. They probably pay 6,000 for the same engine, just to make up this hole, right? Because I can abuse my subsidiaries in order to force this competitor out of the market. Do you see how sinister that is? And it does that a lot. The anti-competitive. Okay, and sometimes like the same thing, the pricing advantage, right? You can price these things anywhere you like, right? As long as you stay within the realm of the law. And goal congruency, we already discussed it. However, is you have to make the money outside, okay, in order to make the real money. So let me see. We already go through this, the arm's length third party. So we sort of described this in this graph, right? The engine company in Japan, the engine company in America, right? And sort of to abuse this intercompany international transfer, right? So we have a two choice here. Okay, we can go over the calculation of transfer price, but I think that you guys won't be able to take it. It's probably not a good idea. People are pretty tired already, I can see from your eyes, right? So what we can do is we can do the transfer pricing question next time. So next time we will do transfer pricing and also the variance analysis, instead of just go through it very quickly in the next 30 minutes. And I think you guys are too tired. I can see, you can see that I can't hold the attention on most of you already. But the goal of this, before we do that, I really want to emphasize the goal of managerial accounting is not the calculation, okay? Is for you to understand how cost is managed, how cost is manipulated within the company to make a particular business objective, right? To achieve a particular business goal, right? And transfer pricing is really, really important in the long-term wise for your career, right? Even though at this setting that the practice question of transfer price is actually not that hard. You just prepare a statement, write the price. Okay, price $8 and transfer, okay, $6 instead of $8, right? But the real art behind transfer price is really that you are able to manipulate it, right? To understand, okay, the internationally, okay, that jurisdiction have a lower tax. Okay, we need to prop up this, our new subsidiary to do certain things, or we need to force our competitor out, to use this kind of scheme to get things done, right? That's the purpose of the cost accounting education, right? Don't just think that it's just a calculation. No, you underestimate accounting, right? if you just think the calculation, only the calculation matter. And I want you guys to be a good accountant. That's the goal. All right, so how do you guys think? Let's do the calculation question on next Tuesday, right? Instead of today. Right, so we'll call it a night. And I will use this remaining time to answer questions. Any questions? Yeah, I have a question. Yeah, Grant.
So I sent you an email yesterday about...
Did you? Okay. Yep. Okay, so if you sent me an email yesterday, I might have missed it. Okay, so what's this? Grant, right? Let me make a note.
That's like a preferred way of reaching, like, would you rather us email questions?
Just email me, and if I didn't answer within 24 hours, don't be afraid emailing me again, because sometimes I just missed it. If for most of you email me, you know that I'm usually pretty good to answer within like 4 or 5 hours. If I don't answer within that time frame, then most likely I missed it. So I will go ahead and look for your email. It's Grant, right? Let me make a note. Okay. Anybody else? Anybody email that I didn't answer? Okay, good. No. Okay, good. All right. Any other questions regarding the classes, the exams, the homework assignments, and if nothing, that's
I don't have a question, but it's not for everybody. Which one do you think makes more money, tax or audit?
audit. In the long run, let me explain to you what's the difference here. Let me use this to explain to you. Okay, so if you compare audit and tax, the audit in the first 5 years, you're considered junior auditor. Okay, your job is boring. Okay? Your job is do the actual legwork of audit. Right? But what happens is that audit industry, you have fresh blood coming into the audit stream every year. That's what they call the fresh meat. That you always have people you can abuse. You stay there 1 year, next year there are new people you can abuse. And next year you have. So once you pass this 5 year, you become a senior auditor. And at this point, basically you lead a team. Okay. So when you start leading a team, you don't do the actual lead work anymore. You just oversee your team's work, right? And after the senior auditor, and for about 10 years or so in the senior auditor, you may move up in the senior auditor's role a little bit. If you stay in the audit arm, right, you may become a junior partner. Okay. And let me explain to you. Let's go back to that asset equals to liability plus shareholder equity. Okay. Okay. So why is that important? Because if you make money, your company make money, right? What happens? You have to give to shareholder, right? Shareholder get a share, right? You see that? But audit firms, there's no shareholder. They are partnership, right? So if you get $5 million after all the expense paid, about $1 million, and you still have $4 million and pay salaries, right? Okay, salary $1 million, so you have $3 million left. They are shared among partners. You see? So you become the partner, you get to share that. So in the long run, if you're auditor, you stay with an audit firm, you become a partner, you get a share of every contract that you bring in, even though you didn't work on it, right? Because you're a partner. Okay. So tax, on the other hand, every year, you do pretty much the same thing. your work is about the same year after year. It doesn't really matter how high you go. You still have to do work because the tax has a special thing is that the younger people do easy tax. The older people do harder tax. You don't get to be like an audit stream once you get to become a junior partner. You know what junior partner do? They go on the golf. They get business. That's what they do. Yeah, that's the primary up the business functions for them is to get new contracts, new deals. But for tax, is the type of career stream, right? The older you become, the harder tax you do, the more complicated tax you do because you understand how those things work. So me personally, right? I really admire tax accountants to stay in the industry for so many years. But you still get to become partners. Okay? You still get to be partners, right? But your share that you share from the junior audit partner is a lot less, right, than the audit partner because the tax partner, the tax contract doesn't change, right? It's very stable, right? So if you look at stability, right, the tax is a lot more stable, but in the long run, audit makes more money. But the most stable is tax because you see, someday down here you don't want it. You can, as a tax auditor, you can close your you can quit your job and be a tax accountant anywhere in the United States, or even you can go to other countries as well. But not the same case as auditor. Auditor can't file taxes like tax accountant. And a lot of my friends that they told me the best accountant, the most happy accountant is small town accountant. Really, you know what small town accountant do? It's kind of like living in the reality show. You work in this small town. You file tax for this town's people. You know everybody's business. Or this guy is going to cut his wife off the inheritance, right? And then all that. That guy's he tried to hide his taxes, or this doctor owes a boatload of money to the IRS. You know everybody's business. It's really fun, and you get to be a position that people trust. So for career-wise, really, tax accountant career is you have much more freedom, right? You are not tied to a particular company. If you want to stay in auditor, you have to stay within that firm to get to this place. Loyalty, right? To be a partner. But with tax, you can quit anytime you want, because your skills, right? The longer you have in a year, the harder tax you can file, and then you can do your tax in Colorado. You can do your tax in New York. You can do your tax in Hollywood. Anywhere, you get to choose the place you live. Okay? Right? If you have the connection, you can be the tax accountant for the mob, or tax accountant for the Hollywood stars. You know, it's completely up to you, right? And it just happens like some of my friends, they love to be like small town tax accountant. They see that's the best job, you know. And from my point of view, is may not be a bad idea. You know, it's like they make good money, right? And they get to hear the gossip of the entire town. It's kind of funny.
So, if you make tax, and if you choose the tax route and you make partner, hypothetically, could you just switch between companies and just be partner in one place and the next place?
No.
Because you already know tax.
And it's not like that. When a partner, right, don't get to immediately transfer to another firm to become a partner in another firm, right? It doesn't work like that. It's like it doesn't really matter you're an audit stream or tax stream, right? It's not like a law firm. Now, sometimes law firm, they want a really good talent. They may offer partnership very soon, like within a year, right? But it's rarely happening in accounting industry, right? The partnership is usually awarded to people who stay with the same firm for a long time, right? They know the clients of this firm, right? They know how to milk the clients, right? And for the tax, you don't get to that kind of yes, you can become a tax accountant from another firm, but you don't get to be changed to partner right away. It doesn't work that way. Because partner get to share the profit of the firm, right? They won't let that happen like within a year or two. No, usually don't. You have to stay in the company, in the firm for usually at least 10 years to make partner. That's usually the case. Right. Interesting, eh? Did you guys like this kind of thing? It's kind of interesting. Yeah, I know. What is better? Any other questions? Yeah, I remember you sent me this email this morning, right? Yeah. So it's harder for me to answer email in the same day because I teach another class at the 1:15. So I usually have to prep the course. But I did answer to you that I haven't heard any other feedback from any other students. Any other student have the same problem, that question 1 from assignment 3? Okay. So Amanda, I may have to look into your assignment, right? It seems like you it's only happening to you, right? And because most of the students they did assignment 3, they haven't told me that they are experiencing this at all. So I have to look into just your assignment only to find out what's going on, right? Okay. All right. So I guess that's all. Right. So thank you for staying this late, and we will do the transfer pricing practice question next Tuesday, right? And we will also get into the variance analysis, only variance analysis. Next week we only cover one topic, variance analysis, right? So it's relatively short. Okay. So yeah, one last thing for the extra credit, right? I really don't recommend to circulate the calculation because the calculation is supposed to be different, right? Everybody will calculate differently. If everybody calculate the same, it lost the meaning. And then I see everything is the same, and I get all pissed off. And okay, I'm not gonna grade you to give you too much points. Yeah. So discuss, but do it yourself. It's actually not that hard. Set up an Excel spreadsheet. You have 2 weeks to do that. It's actually quite adequate to just do one problem. Right? 2 weeks for one problem is not that hard. Right? And we spend a lot of time today talk about different ways of set up transfer price and what's the potential advantage of doing things one way or another, and that should help you in terms of writing the extra credit case. All right. Okay. Bye. See you next week. Have a nice weekend. Bye-bye. Shut up. Shut up, you. You shut